Thank you so much, Doug, for joining me. I'm thrilled that you could chat with me this afternoon.
Happy to be here. Thanks for having me on.
Thank you. And I'm really excited about your book, Family Inc. I'm always fascinated to see how people approach money, and especially with marriage, there's so many different perspectives and circumstances. And you have a unique perspective because of your background. Doug, do you mind introducing a little bit of how you got into finances?
Sure. So I'm a little bit of a journeyman, meaning that I got into investing as a hobby that my dad promoted as a very young man. And then I went to the United States Military Academy and actually served in active duty for a number of years. And then made a career transition where I went back to business school and then have spent some combination of time on Wall Street in an investment bank, working for an investment firm, and now I'm an owner of an investment firm. So I feel like I'm an entrepreneur today, and I think that broad perspective, kind of allows me to come at some of these topics from a slightly different vantage point than much of the advice you'll get out there today.
Yeah, and that's what I appreciate about your book. It is very detailed oriented. You have the numbers, you have the stats, but at the same time, this is coming from a perspective of a family that wants to succeed with their finances and how to approach it like a business. So I wanted to talk about a topic that a lot of people have been emailing me about, especially now, open enrollment, and they're thinking, okay, let me set myself up for a great year in 2018 with finances, and that's with investment contributions for retirement. A lot of couples, honestly, are trying to do it all. They know they're supposed to have the emergency fund. They're supposed to have pay down their debt. They're supposed to invest in a 401k, the IRA, and they feel like they're being pulled in so many directions. But your book goes into having a specific plan to help couples, to help families figure out, okay, this is where our priorities are. So I would kind of be curious if you can give us like a high level view, like what are the layers or the steps that families need to take in terms of investments and priorities?
Absolutely, Elle. And first of all, let me say your question hits on the exact reason why I wrote the book and why I came up with the philosophy. Because in isolation, there's lots of good advice out there. Invest this way, get this kind of insurance. Is school a good investment or not? And what I personally struggled with was trying to make sense of all that good advice for my own personal circumstances when I had competing demands. Do I invest my money to pay down debt? Do I invest in equities, et cetera? And so the whole premise of the book, Family Inc., is that we're all, in some ways, we could manage our finances like a business manages its finances. And if we borrow some of the principles from, corporate America, we would actually make better decisions. And so with that as kind of the overarching framework where you're looking at yourself and your family as a business owner, and you own two assets, really, your labor assets, how you make money at your day job, plus your financial assets, you can really kind of help prioritize those choices you make. So I would say in terms of rough framework, the very first thing a family must do is ensure that they don't go out of business. And by that, what I mean is take care of the critical insurances. The most biggest need that families often have that is neglected is disability insurance. I would argue that life insurance is a real critical need as well, and then also umbrella insurance for liability. And those are not insurances that you're paying for to give your family a windfall if something bad happens. It's really to replace the loss that you experience when someone passes away or someone is disabled. So first and foremost, in kind of the pyramid of things that you've got to do, it's insurances. For me, then, the second is an emergency fund. And I recommend generally 3 to 6 months of available liquid cash to support yourselves. And that's really based on the belief that life is uncertain and you've got to be able to protect yourself against financial distress. And you do that with an emergency fund. After that, to your question about 401k enrollment, that's clearly the next priority for me. And it's the next priority because it's so attractive. And the reason that 401k is so attractive is it's got really attractive tax benefits in terms of deductibility and deferment of taxes. And you also often have company matching programs. And so those two things make that a very attractive investment. From there, I go down to pay down debts. And there are different kinds of debts. Some I choose to pay down, some I don't.
Yeah, I saw that.
And basically the general sense is that if you're paying down a debt, I look at it as paying myself. And how
Hmm.
does that money going to perform in the stock markets versus just paying it down myself? Obviously, if you're paying down debts, that's a certain return to yourself.
Hmm.
If you have it in the stock market, there's a little bit of risk. It may go up or down.
Makes sense. Makes sense. So I know everyone has, like you said, like good advice in isolation, and you recommend like having that emergency fund pretty fully funded before you even start with the other steps. First, family, maybe they feel like would that might delay us saving for retiring or paying down debt for a year until we can get that funded. Do you see that as a concern, or why you feel very strongly about having a full emergency fund?
Yeah, I would say in some cases I've seen families create their emergency fund by a home equity loan or availability on a loan or some kind of borrowings. And I think that is acceptable, but usually folks that have those kind of resources also have an emergency fund. So
Mhm.
my view is that the number one thing that families struggle with is the cost of financial distress. If you
Mhm.
experience bad credit, if you experience a bankruptcy, it's really tough to overcome that. I contrast that to if you approach retirement and you have not saved as much as you'd like, you can always work longer, you can spend
Mhm.
less, you can invest more. And so I think there are ways to solve the savings problem on the back end that are easier than dealing with financial distress early in a life.
Those are some good points. And I noticed, like you had mentioned, some debts you were saying, hey, pay those off first. Others you can kind of put off a little longer, like the student loans and the mortgages. And I'm assuming car loans that are low interest. But for a couple that's listening and they're trying to decide, like, what's our measurement? Like, how did you come up with a cutoff point of which loans to pay down faster versus later?
Yeah, it's a little bit dependent on individual circumstances,
Hmm.
but in general, my view is in today's market, investors can expect over the long term to achieve 4 to 5% after tax real returns on their investments. And so if you compare that to what your cost of interest is, I think
Hmm.
that's a good kind of trade off. So, very bottom line, if you're paying interest that's more than 5%, I'd pay it off
Okay,
and pay yourself that interest rate. And if it's less than that, I'd probably keep it invested in the markets.
great. Great. Now, I loved how you tackled not just what you should do in the numbers and the rationality, but you also address kind of the psychology. We have investment returns and then we kind of have investor returns.
Yeah, yeah. And
Yeah.
unfortunately, investment returns are often better than investor returns. And listen, I think it's about being real with yourself
Hmm.
and acknowledging that there are rational decisions and then there are
Hmm.
emotional decisions. And I think you can manage the emotional decisions by educating yourself well.
Hmm.
But I think understanding some of the biases that go into how we make decisions is a helpful way to, um, ensure that you're making good decisions up front that you can live with when life and the markets do what they do.
That's true. So, in your experience, has there been like one or two that you see these mistakes that couples make over and over again that sabotage their retirement plans, what they intend to do, and what's actually happening? And if so, how could they counteract it?
Yeah, so there are a couple things, and I would say in many cases they're not necessarily mistakes, but they're lost opportunities.
Okay.
So these are along those lines of lost opportunity. I think that very successful managers of wealth think about things over a very long-term time horizon. And
Hmm.
it's so easy to get caught up in the day-to-day news cycle of Apple's up a lot today and it's down a lot tomorrow and making decisions that are short-term in nature. So I think the big number one piece of advice I have for folks is think long-term. And when I say long-term, I
Hmm.
think decades. If you're in your 30s today and you're thinking about retirement, you're really talking about a 30 or 40-year period that you have to manage. And when you think long term, I think you can take a more aggressive investment posture in terms of your asset allocation. So,
Hmm.
in general, I think people are underexposed to equities.
Hmm.
And I think if you have a long term focus, the risk associated with the day to day ups and downs diminishes dramatically. And then the last thing I say that people often don't do well is for most families, your number one asset's your labor.
Mhm.
and thinking about how to maximize the value of your labor through education and job choices is a real important success factor to financial security.
Yeah, I saw that. That was towards the beginning of the book with the first couple of chapters, I think the second and the third, and did a good job of breaking down not just the degrees and the differences with income over the lifetime, but I found it fascinating. You broke down also your majors and what you get a degree in and how that can affect your
Yeah,
finances.
I think it's challenging because I think young people, call it 18 to 20,
Mhm.
often aren't thinking about their lifetime earnings
Mhm.
trajectory, but they're making decisions that are going to dramatically influence them. And so, I think we all owe it to, our youth of today to really help them understand which degrees pay more and what kind of college education is a good investment versus not. And I'm not saying that one career is better than
Mhm.
another, but I'm saying that people that are well informed and understand the financial
Yeah.
consequences of the career choice, that's ideal.
And I think you make a good point because they're adults, and that's one of the first decisions is, here's the income you could expect. And therefore your other choices, whether you pursue, get a more aggressive about scholarships or doing a work study, because you don't want to have a large loan or it's going to take longer to pay it back. Those are considerations to have, and those are good discussions to have as a family before the financial aid's right in front of you and you're just going to say yes to whatever they have.
It's arguably the single biggest financial decision that a young person makes, both where do I go to school, what do I study, and do I go to school? And so to have that important context, I think, is super valuable.
Yeah, most definitely. Well, thank you so much, Doug. I appreciate your help with this. Again, guys, if you haven't already, please pick up Family Inc. It's a great book full of information, and I love how you break it down, the numbers in the context of a family unit. So, Doug, if they want to get more information from you, ask you a question, pick up your book, where can they go?
Sure. A couple easy ways. First of all, there's a website, familyinc.com. That's FAMILY Inc. INC period.com. And it's on Amazon and Barnes and Nobles. And appreciate the interest in the sport.
Thank you so much. I hope you have a wonderful afternoon.
Great. Thank you.